Good morning, viewers. Welcome to our Q2 Alternative Dashboard. I am Brunette Gasson, CRO of Catalyst Fund Managers, and this morning I'm joined by Marcus Erlang, Director and Portfolio Manager of our local listed property hedge fund. Marcus, let's kick off. As we know, this year has been year to date marked with quite a lot of volatility. And I say that because we know it's been happening globally and in South Africa. Slightly different reasons, but we know that despite all of this, actually SA listed property has been performing quite well year to date. Can you maybe unpack this for us, and where are you seeing some further opportunities?
Yeah, sure. As you mentioned, it's been a first half which has been exceptionally volatile from a macro and geopolitical point of view, locally and globally. And I think it's just been a very tough environment to manage money in, especially for a hedge fund which has the dual mandate of, not only protecting capital but then delivering absolute returns. So obviously at the beginning of the quarter, you had the perfect storm, I guess, of Trump's tariffs going live on Liberation Day, but also a fairly fragile GNU, which obviously sent markets into a complete tailspin. Obviously in April then what you had was Liberation Day coming in the US, and it sort of coincided exactly with some extreme frailness being seen in the GNU. So you had deep drawdowns within global equity markets. I think very quickly, with a 90-day pause in US tariffs and the DA recommitting itself to the GNU, you had a stunning reversal of share price performance. And with sort of slightly more calmer waters in South Africa, the market has focused again on fundamentals. So as I mentioned, the fundamentals have been strong and growth has been good in South African property stocks. So I think that creates a favorable backdrop for SA Inc.
Thanks, Marcus. And I think when you speak about volatility, we know it can present risks, but there's also a lot of opportunity in that. So luckily for you, you've got all these nice hedge fund tools that you can implement and deploy within your local listed property hedge fund. How have you been doing that? Like, what type of tools have you been implementing? Yeah,
I think as much as I mentioned earlier that running a hedge fund in this sort of very volatile period presents it's been very tough. It does also present an opportunity, and I think to have the tools available to be able to not be fully invested or have heightened short exposure through periods of extreme volatility, it does add comfort. Other than the traditional tools of a hedge fund, which, like I said, is to be in or out the market, be long or short the market, the fund has employed a couple of additional sort of strategies in the last quarter through this volatile period. The fund tends to, keep its offshore exposure quite unhedged. So what we find is that in periods of extreme crisis, like we had in April, global markets sell off, but you also have a commensurate blowout in the ZAR versus major currencies. So on an underlying basis, that actually does create quite a nice smoothed return in ZAR. So I think when you take the local listed property and you take the global listed property, that you've already got the uncorrelated return between them. When you overlay the ZAR, you get almost no correlation. That, in combination with being able to hold some cash in the fund, can actually smooth over some very volatile periods. In the quarter, we did increase our hedging to lock in some of that ZAR weakness. So we've done really nicely out of that by hedging the currency out at mid-19s to the dollar, and then seeing it come all the way back to mid-17s, so you can crystallize some nice alpha in that regard. What the fund also realized was that in the height of the GNU sort of fragileness, the bond yields within South Africa moved out a little bit. We realized there was an opportunity, and obviously the natural opportunity is to deploy capital into equity markets. We realized that there was a very heightened risk that things could get worse before they get better, but as a sort of a method to be able to capture some of the potential recovery while still being cognizant of the downside, the fund took a position in a enhanced cash fund that had some underlying long bond exposure. So what you find there is that you get the upside when bond yields firm, but further downside was limited because you don't expect bond yields to go much beyond 12 or 13% even in a period of crisis. So that worked really nicely. I think you've seen off the April lows that the all bond index has rallied between 6 and 8%, which is sort of in line with what equity markets did, but we did it at a far lower volatility. Then another interesting strategy that the funds employed during the quarter was we did realize there was an opportunity to get into general equities or into listed real estate markets during the heightened volatility of Q2. But we were also cognizant that there's quite high concentration risk within SA property. The larger cap stocks do make up, Growthpoint, Redefined, Resilient. They are all quite big constituents within the index. The fund does not like taking, double-digit size positions within one stock. We think the concentration risk is a little bit too high. But we did realize that you did want some, beta to listed property after it had sold off like it did. So the fund could actually, within the volatility, take an option structure whereby you're buying an in-the-money or an at-the-money call option, but you're selling a call option and a put option out the money to be able to fund it. And because of the heightened volatility, the premium you could actually raise from selling these options was enough such that you could buy the at-the-money option. So you're getting a portion of the upside, but you're quite well protected from a portion of the downside if things were to get a little bit worse. And that structure, I think, we managed to increase our exposure to SA listed property without taking undue risk.
Marcus and viewers, we know that the QIF, or the qualified investor version of your hedge fund, is almost 20 years old. We'll be celebrating that in November later this year. But then we've also recently launched the RIF alongside Amplify. And last time we were singing Amplify's praises because we really value them as a strong distribution partner. Please tell us, how has that been going? It's only been a few months, but yeah, what are your views?
Yeah, I think we're really proud to have launched this fund on such a strong platform and with such a strong partner being Amplify. I was joking with the Amplify guys that a lot of the other hedge funds, they launched a month or two before COVID hit, and how satisfied or how happy I was to be launching this product in a period of calm within the market. So we launched in February, March of this year, and calm it has not been. But once again, using the tools we have at our disposal, we've navigated the extreme volatility of the earlier part of the quarter, which we have discussed at length. And by being positioned in SA-centric stocks, which have delivered strong share price performance, we've managed to deliver positive returns at a far lower volatility. And I think, hopefully the best is yet to come.
Well, we're looking forward to seeing what you can deliver. As we all know, the QIF is sitting at, correct me if I'm wrong, is sitting just shy of like 16% net of all fees per annum since inception, right? So
correct.
We will wait and see.
Yeah.
Marcus, and then last but not least, if we look at the global spectrum and we looking forward, what's your outlook, and more specifically, like how are you positioned within your fund? If let's focus on maybe obviously South Africa, but then especially the US narrative versus Europe.
Yeah, I think just compared to the last time we sat here, which was in January this year, if I look at how the portfolio construction has changed, we've definitely upweighted SA Inc. Like I mentioned earlier, and like we discussed earlier, we're very bullish on SA Inc., especially property. We think we're at the beginning of a new growth cycle. And I think with our governor speaking to a potential 3% target, and where bond yields are where they are right now, you're getting a 7 or 8% real return ahead of inflation just by investing in sovereign debt. So I think what we expect to happen is possibly for long bond yields to come in, and that will benefit SA property. So you would not just have a situation where fundamentals are quite strong within South Africa, you've got a decreasing interest environment and a potentially firming bond yield environment, which should support SA Inc. for a little bit longer. What you've also seen is, and this is speaking more towards global markets, within the fund is we've actually downweighted offshore a little bit, not because we don't see value in offshore. We do see value in offshore. We probably just see a little bit more value in SA. And also the funding for both SA and Europe and UK has come from our exposure to the US. We think there's a great opportunity within UK, Europe, which has been, largely ignored from a real estate investor for a long time, and it shows a compelling combination of yield and growth in certain subsectors within Europe. What you've also had in Europe is a far steeper declining interest rate cycle. So in terms of refinancing risk and return spread to what the underlying long bond yield has done, it does create a compelling investment opportunity. That being said, though, you ignore or you bet against the US at your own peril. So we are still optimistic about the fundamentals within the US. We just realize that there's possibly a little bit more political noise around the region right now. So we are still invested in the US. We are still long the US. A lot of the interesting niche subsectors are incubated out of the US, and you actually can only get in the US. And the optionality is so great that you get very good pair trading opportunities within the US. So we have upweighted SA, we have downweighted the US, and we've upweighted UK, Europe. I think, if anything, what has resonated, I think, with investors around the market is that the no-brainer of being overweight developed markets and overweight the US within developed markets, possibly investors are thinking a little bit different, and they're saying, the incremental dollar probably needs to be invested somewhere else to decrease the concentration risk of being in the US. So I think that has benefited the UK and Europe, and I think also it's actually benefited emerging markets. So you are seeing a lot more optimism for emerging markets as the incremental dollar is looking for a home elsewhere in the world.
Marcus, thank you so much for your time. There's so much going on at the moment. It's tariffs, it's geopolitical tension, and then there's sometimes often just noise, right? So there's a lot to navigate.
Yeah, correct.
Viewers, thank you so much for your time. If you'd like to learn more about our dashboard, please refer to the Q2 version, or alternatively, please reach out to me as per the contact details below. Thank you and goodbye.